Hey YouTube, this is Zach with Achilles Financial, and today we're going to be talking about STEM and in particular their last earnings. As of right now, the stock is currently trading at $3.67. That is as of close on Friday after hours. Now it's important to note that they had a pretty weird trading day, and I think that it's more so market moves versus the stock in general. They did get a downgrade from buy to neutral from the Guggenheim analyst, and there is still a lot of movement associated with the stock, but I think that their earnings were frankly just meh. They had some good news in there, they had some bad news in there, chiefly associated with that revenue number that came out. And it's important to note that they are still trending to be EBITDA positive in the latter half of 2023, which means they are going to need a big Q4, and it's going to have to be an EBITDA positive Q4 as well. So in the announced Q3 earnings, which again, if you want to see that earnings call, it's going to be available on the STEM website where I'm at right now, or it's also available here on the channel. It's going to be the prior video under the live section. So you can see they are reaffirming that EBITDA positive in 2023. They did announce a pretty large deal that is primarily software related associated with SoftBank Energy Group, that SB Energy. And important to note, one of the questions that was asked as part of the Q&A section, that there was no revenue associated with this deals in the Q3 earnings. So this could be a super important agreement that could bode well, especially because it is entirely software associated, or services and software, and that's going to be the higher margin areas associated with the company. From a bookings perspective, they continue to show incredibly strong bookings numbers. And again, that was well above the guide for the quarter. They are well on their way to beating the annual, or rather the 2023 expectations there. So there's a lot to like on the booking side. But like I mentioned prior to, or I guess going into the conversation, is we really have to acknowledge that they are continuing to lose money at a higher level, primarily due to revenue making a big miss right here. So you'll note that the revenue of $133.7 million was under expectations, and that's associated with an adjustment that they used to have a $37.5 million reduction in revenue. Now, the executive team is able to speak to this a lot better than I am. Again, this is once again on the video, but this is associated with the way that the contract was set up, which was heavily favorable to the buyer versus the seller being STEM, that essentially said based on different prices for batteries, they would be able to adjust essentially how much they're expected to buy and or deliver on. Again, there's more information associated with that within the other sections, but they are no longer utilizing this type of lending. The reason they did in the first place is because they were really trying to bring in additional business there. And so they have the capability to run with that or not use that anymore. There's a small amount of this that will adjust or impact Q4, but they've adjusted the annual revenue down by that $37.4 million, meaning the expected guide is going to be down as well. And down below, you can continue to see that net loss pile on, and those gross margins are not necessarily where we want them to be. However, bookings continues to go up materially, as well as that CARR revenue, or that contracted annual number there. And I think that is a huge component here, is that they are well ahead of where they originally anticipated in terms of being up from an annual recurring revenue perspective. So this is getting locked in. Again, there's a real possibility now this could be $100 million by the end of the year. Down below, again, they walk through quite a bit of the numbers, but to look at that or to speak to that, I am going to pop over to the presentation. Now, I'll have all of this information in the description down below, but you can find this on the STEM website. Just once again to highlight some of their highlights: strong growth in CARR. Again, this is a metric they have. Annual recurring revenue is very common in the software space, but a lot of this is more so on the services side. You can see that revenue is continuing trending upwards nicely. And then, although there was a miss, and then bookings was up massively, which is, again, a very strong approach there. They also launched this new Power Bidder Pro, which is essentially going to be a stronger version of the Athena platform that the clients have access to versus necessarily having to leverage the STEM team to be able to utilize, which will make a stronger conversation or hopefully a strong conversion rate for those sales teams. You can see some of those third quarter highlights, that CARR number continuing to track upwards, as well as those booking numbers showing very, very strong returns. And they highlight that, hey, their debt continues to remain very low from a interest rate perspective. Demand continues to remain high. They just need to go out and continue to execute on those bookings numbers that they've already closed down. So the question is, can the company continue to perform in a materially strong way? Some of the concerns I have with this is that they continue to perform well, but just not good enough, but just not poor enough. So there's a lot of great things going on with this company right now, but at the end of the day, they're not exceeding expectations. It's always some level of excuse for something going wrong. I still have a lot of faith in the management team to run the company. I don't necessarily see that faith reflected in the stock going to be able to 500, 600% from here within the next 12 months. That being said, at this point in time, due to my cost basis, I expect to continue to hold because it's kind of a sunk cost fallacy where I'm expecting to just kind of hold and hope for the best. Because the company is continuing to grow, I don't see a solvency issue right here. And if this is something that I have to wait 2 or 3 years to see returns that I would expect, at this point in time, I feel comfortable doing so, especially recognizing that a larger percentage of my safe cash continues to be in accounts earning north of 5% risk-free via treasuries and CDs. Associated or tying this back to STEM, I would note that they continue to expect operating leverage to decline, which is great. That's going to help them increase their cash balances. It's going to help them increase their margin. And a lot of this is going to be something that we see going into 2024. From an operating metrics perspective, that backlog continues to grow. This is good, but still iffy on these numbers because remember, this can be canceled always. And the storage and solar revenues continue to go up associated with their increases in assets under management, which is that AUM number that you see down below. From a full year 2023 guidance, I would note that they reduced it by that $37 million. That can be very painful, although I'll still give the company the benefit of the doubt if they can hit that $550 million, which would have been the low end of the prior guidance. If they're underneath that, I do see major pain points associated with that. Again, I'm expecting another quarter of strong bookings, and they now have the capability to beat this CARR number by going for that $100 million, which may happen. The adjusted EBITDA, this is what I'm interested to see. It's got to be positive in Q4 for the full year 2023 numbers. So some of the things that I want to highlight as the last numbers that I would call out is going to be in the other document. So I'm going to pop back over there. So what I'm showcasing here is the balance sheet, and it's important to note that cash did go up quarter over quarter. We like to see that. Accounts receivable actually increased, which is not great, although again, we're not seeing any major differences there. But something that's going to happen here in the third quarter, they did say on the call they expect this cash account to go up and then be closer to that 150 million. So they've got to deliver and collect. So deliver on a lot of that revenue, collect on a lot of this accounts receivable that's outstanding to get that cash position in a strong position. They said at this point in time, there's no intention to perform any type of capital raise, cash raise, so I would expect that cash balance to be going up materially. They shouldn't need to have any further dilution, and it's important to note that right now the company is trading at a total assets well above what they're seeing from a market capitalization perspective, which is great. We like to see that, especially when your cash account, your accounts receivable account is around $300 million, companies trading around $500 million. However, I do want to respect the fact that we still have liabilities out here, primarily going to be associated with those debt accounts. That being said, overall, the company continues to maintain a very strong position from their debt and what they have to pay on that debt. So therefore what? What's the end goal associated with STEM? They continue to grow comfortably from a revenue and bookings perspective, but the profitability has to materially improve. I think that the approach over the next couple of months, especially given the broader macroeconomic environment and how there could still be downward pressure on stocks, especially if we start seeing some of the mega caps start breaking, is that STEM is a company that I think is in a position where they will definitely be able to survive going forward and hopefully stand on their own two legs. The question is, can they get to the point where they are increasing revenue so much that cause that double, triple stock price return where you see it go from $3 back to $6, from $6 to $18. I'm not saying it's unrealistic to say that that could happen within the next 24 months. I'm just not necessarily counting on it unless they show material growth in their software package, which potentially that SoftBank deal could do. At this point in time, within the next 4 to 6 weeks, I have zero intention of purchasing additional STEM stock. However, I hold a material position in terms of allocation in my overall portfolio, and I will continue to remain optimistic, and I may continue to sell covered calls on those shares, depending on what happens over the next couple of months. The team continues to perform, but the question is, are they performing good enough? We'll continue to watch. If you found this content helpful, please leave a like and subscribe. Thanks. Talk to you later.